Today is Monday, July 24th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research here at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Alan, yesterday, the IMF revised down its U.S. growth forecast for the year from 2.3% to 2.1%. In spite of this bearish news, stock index futures are holding up pretty well today. Are you still of the mindset that the long-term bull market will continue?
Yes, I absolutely am. The little pressure that we are seeing, I think, is not going to follow through today. In fact, I would not be surprised to see a move back to higher on the day in the indices. Longer term, as long as interest rates stay relatively low, which I think they will, we would expect stock index futures to continue to advance. And in fact, I think this bull market will follow through to the upside, at least for the balance of this year.
Steve, talking about the grains for a minute, U.S. corn and soybean crop ratings are below last year and below average, but prices have been declining. Why is that?
I think it's two reasons. I think number one is we don't have like a severe entire Midwest drought. You've got crops in the northern part of the central Midwest and the eastern Midwest and down in the Delta that are just as good as normal. The problem is in the southwest part of the Corn Belt in Nebraska and maybe up in South Dakota. So it's not a widespread drought. The second thing is that when we look at global demand, U.S. accounts for 16% of the domestic demand in beans, 30% in corn, and only 4% in wheat. So, what happens here is important, but what's happening globally is even more important. So there continues to be competition for our exports. Our exports are declining, and the decline in exports helps offset the lower crop.
Alan, looking at the dollar, we felt a new 13-month low today before a mild recovery on what is pretty limited news day. What is your outlook for the U.S. dollar index?
Well, the outlook has remained unchanged. We continue to believe that the dollar will fall through the balance of this year. And what's really happening is the Fed is very slow, I think, to raise rates, while other central banks around the world are backing away from their easy credit policies. In fact, the ECB could announce that very same thing at the end of this year. The Bank of England could be raising rates sometime next year. So interest rate differentials are very much working against the dollar index. So any 50-point rally that we do see in the dollar, I think, should be used as a selling opportunity. There's a lot left to the downside.
So staying with interest rates, with the IMF saying that the U.S. economy will expand more slowly in 2017 than previously predicted, how has the probability of future Fed funds hikes in December and further on down the road changed?
Well, basically, it looks like the possibility of a rate increase, first of all, at the Wednesday meeting from the Fed is only 3%. At the December meeting, it's dropped now to 47%. Last week, it was 51%. Our feeling is that the Fed will be forced to embark on a slower pace of rate increases. I would expect the next Fed funds rate hike to take place sometime in the first quarter of 2018.
Steve, flipping back to the grain markets, what do you think is the best outlook for prices over the remainder of the year?
Well, I'm afraid that the problem is that the crop is small enough that we probably raised the downside objective of the harvest lows. But the export demand is slow enough that we limit the upside. So what we could finally is establish a range-bound market that trades sideways for much of the remaining part of this marketing year.
What about China? Steve, can you comment on China, who has been a very slow buyer of world soybeans, and why this is?
Well, in digging into the data, right now they have some negative crush margins because of slower pork demand. We're trying to figure out, why their demand is slowing down, because it feels like their economy is actually getting a little bit better. So I think the main thing that we'll be looking at right now is that maybe the price is too high for them to come in, step in and buy the beans, and that at some point in time they will step up their buying. They need to buy 90 million tons for an annualized basis, and divide that by 12, they've got to buy a lot of beans every month. They are kind of snooping around in the August timeframe for South America. South America has a record supply to sell them, but we are a little competitive for September. So I think the price is too high. I think the demand has slowed, but I think they will pick it up.
And what's the current net managed fund position in the grains, and is this affecting prices, or will it affect prices?
One of the problems that we had is overall the fund position is relatively small. But last week we were looking at a forecast of hot and dry weather across much of the Midwest. So they increased their net long in corn to 100,000 contracts, long 50,000 beans, long 35,000 Chicago wheat. That position is a bad position for them if the weather has changed to a more benign forecast. So even though the position is historically small, they may want to get out of that position, which would be negative to prices.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Arthur Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.